If I knew every decision I was going to be perfect, it would not be as much fun. It'd be like playing golf and knowing you're going to hit a hole-in-one on every hole. You wouldn't play golf if every time you got on a tee, you just took a swing and the ball ended up in the hole. It'd be fun for a few days and you get on TV, but the game would not be any fun. So it's failure, and I wouldn't even consider them failures, but they're mistakes or whatever you want to call it. They're part of the game.
Hello, savvy investors. Today, we're diving into the intriguing world of one of the most successful investors of all time, Warren Buffett. But hold on, because we're not just talking about his victories. Nope, today we're exploring Warren Buffett's failures and the valuable lessons we can learn from them. So grab your notepads, and let's jump right in. Warren Buffett, often referred to as the Oracle of Omaha, has built an empire through his shrewd investments and wise financial decisions. However, like any great success story, it's not all sunshine and rainbows. Buffett has faced his fair share of setbacks, and that's what makes his journey so fascinating. Warren Buffett stands out as the foremost advocate of value investing, boasting a deceptively straightforward investment philosophy. Berkshire Hathaway's overarching goal is to acquire businesses, whether in their entirety or through partial ownership, that are skillfully managed and exhibit enduring economic strengths. Naturally, the economic dynamics of the transaction must be favorable. Buffett often illustrates this investment philosophy with the metaphor of a cigar butt, a discarded, mostly used cigar that others have overlooked but still offers a few remaining risk-free puffs. This imagery captures the essence of Buffett's approach to identifying undervalued companies with untapped potential, emphasizing the importance of recognizing overlooked opportunities in the market. Let's rewind to the early days when a young Warren Buffett was learning the ropes of investing. One of his early missteps was investing in companies solely based on their low stock prices. As he admitted, he was focused too much on the price and not enough on the value. A cheap stock doesn't always mean it's a good investment. Lesson number 1, focus on value, not just price. Buffett learned that the intrinsic value of a stock is far more critical than its current market price. It's a lesson that echoes through the corridors of investing wisdom. One of his early failures was the textile company, Berkshire Hathaway. Buffett invested heavily in the struggling business, only to realize later that the textile industry was not his forte. He learned the hard way that not every business is worth investing in. It's crucial to understand your circle of competence. Buffett discovered that focusing on industries he understood well was key to his success. It's a lesson for all of us: stick to what you know, and you're more likely to make informed decisions. Now, let's discuss Buffett's foray into the tech world during the dot-com bubble. Buffett famously avoided technology stocks. However, he eventually invested in tech giant IBM in 2011. His reluctance to invest in technology stocks eventually gave way, but not without its consequences. Buffett admitted that he missed out on some golden opportunities during the dot-com era. He stated, "I made a mistake on that. That was my worst mistake probably in the last, certainly in the last 10 years. The lesson here: don't let fear of the unknown hinder your potential gains. While it's essential to stay true to your principles, being overly resistant to change can lead to missed opportunities. Strike a balance between tradition and innovation." Investing in Tesco posed a significant chapter in Berkshire Hathaway's portfolio. By the close of 2012, the conglomerate held a substantial 415 million shares in the UK-based grocer. While the firm did sell off some of its Tesco stock, it remained heavily invested. However, the investment took an unexpected turn in 2014 when Tesco overstated its profits, causing a sharp decline in its share value. In his 2014 letter to shareholders, Warren Buffett candidly revealed that concerns about Tesco's management prompted the initial sale of stock, resulting in a $43 million profit. Regrettably, the subsequent actions were not as swift as needed. An attentive investor, I'm embarrassed to report, would have sold Tesco shares earlier. "I made a big mistake with this investment by dawdling," Buffett wrote, acknowledging the delay. The consequence of this delay was a staggering $444 million after-tax loss for Berkshire Hathaway. The lesson gleaned from this episode in Warren Buffett's history is crystal clear: prompt decision-making is paramount in the world of investments. It underscores the importance of agility and a proactive approach, emphasizing that hesitation in responding to red flags can come at a significant cost. So far, the mistakes we have seen were mostly errors of commission. But here's a mistake from Buffett that qualifies more as an error of omission. In 2017, Buffett admitted that he had followed Amazon.com for a long time but never chose to invest in it. In his own words, he said, "I was too dumb to realize. I did not think Jeff Bezos could succeed on the scale he has." Buffett had underestimated the brilliance of Amazon's execution in two industries. One is the company's dominance in e-commerce. And two, its success in the cloud with Amazon Web Services. The lesson to draw from here is that of compatibility and evolution. The traditional Buffett approach is not tuned to buying a stock that trades at a rich price-earning ratio of 80, 90, or 100. It was where Amazon was in 2019. And add to this the fact that Buffett turns a blind eye to technology companies. They are not within his circle of competence. In that context, it's not difficult to understand how costly an error of omission can become. So, it is crucial to have a circle of competence. But it is even better to evolve and expand that circle over time. As you may already know, adaptability is key. Warren Buffett wasn't afraid to admit his mistake and adjust his strategy. It's a reminder that the ability to learn from errors and pivot is crucial in the ever-evolving world of finance. Now, let's talk about one of Buffett's most well-known missteps, the airline industry fiasco of 2020. Buffett shocked the market when he sold his stakes in major airlines as the pandemic hit. Critics questioned his decision, but Buffett had his reasons. The world has changed for airlines. And I don't know how it's changed, and I hope it corrects itself in a reasonably prompt way. The lesson here, don't be afraid to cut your losses. Even the greatest investors can't predict every turn. Buffett's move reminds us that it's okay to reassess and let go when circumstances change. Being pragmatic and reassessing your portfolio in turbulent times is crucial for safeguarding your investments. So, as we wrap up, Warren Buffett's investment journey is marked by both successes and failures. Each failure provides valuable lessons for investors, emphasizing the importance of continuous learning, adaptability, industry knowledge, and the patience to weather market fluctuations. While Buffett's approach may not be replicable in its entirety, the principles derived from his experiences can serve as guiding lights for investors in their pursuit of financial success. Thanks for joining us on Fail to Learn. If you enjoyed this video, give it a thumbs up, subscribe for more financial insights, and hit that notification bell. And hey, if Warren Buffett can learn from his failures and keep growing, so can we. Until next time, happy investing.